Buying your first home in Canada can be exciting, but it can also become one of the most expensive financial mistakes of your life if you buy before you are truly ready. Because qualifying for a mortgage does not automatically mean you can comfortably afford the home. And saving the minimum down payment does not mean you have saved enough to complete the purchase. In this video, I will walk you through 7 smart moves to make before buying your first home in Canada. I will also show you how much cash you may actually need to purchase a $650,000 home, because the down payment is only the beginning. Just before I show you, I am Tosin Ailiafen, a licensed life insurance broker and a financial educator in Canada. On this channel, we discuss practical ways to protect your income, use Canadian financial accounts effectively, and build a stronger financial future. If you are planning to purchase your first home in Canada, subscribe and stay with me, because this could help you avoid some costly mistakes. This information I am about to share is for general educational purposes. Your first move is to decide whether you are financially ready. This first smart move is to determine whether you are ready to own a home, not simply whether you want one. For many newcomers and Canadian families, home ownership represents stability, success, and feeling that we have finally arrived. Please, do not buy a house because your friends are buying or because family members keep asking, when will you become a homeowner? It is better you ask yourself this: is my income reasonably stable? Do I expect to remain in this location for several years? Can I manage the mortgage and other housing expenses without depending on overtime? Do I have an emergency fund? And will I be able to work towards my financial goals after buying? Home ownership can be rewarding, but it also comes with responsibilities that renters may not have. When the furnace stops working, the homeowners cannot call the landlord. Your goal should not be to buy as quickly as possible. Your goal should be to buy when the numbers support you. Now, the second move is to calculate the true cost of home ownership. This second move requires that you look beyond the mortgage payment. Your housing expenses may include the mortgage, property taxes, home insurance, utilities, condo fees where applicable, repairs and maintenance, and possibly higher transportation costs if you move farther away from work. Then there are upfront expenses. These may include legal fees, a home inspection, title insurance, property tax adjustments, moving expenses, and other closing costs. The Financial Consumer Agency of Canada suggests preparing approximately 1.5% to 4% of the home's purchase price for upfront or closing costs. Okay, let's use $650,000 home as an example. The minimum down payment would be 5% of the first $500,000, which is $25,000, plus 10% of the remaining $150,000, which is $15,000. That produces a minimum down payment of the $40,000. But that is not necessarily all the cash you will need. Closing costs of 1.5% to 4% on the $650,000 property could be approximately $9,750 to $26,000. That means you may need roughly $49,750 to $66,000 before considering moving expenses, new furniture, or your emergency reserve. That is why you should never prepare only for the down payment. Now, the third move: prepare your credit and cash flow. This third move sets you to prepare your financial profile before looking at houses. Review your credit report and check for errors. Avoid missing payments. Keep your existing debt under control. And be careful about financing a new car, applying for multiple credit cards, or taking additional debt before your mortgage closes. Your lender may review your income, employment history, credit, existing debts, down payments, and monthly financial obligations. Get a mortgage pre-approval before becoming emotionally attached to a home. A pre-approval may help you understand your possible price range, but it is not a final mortgage approval or a command to spend the maximum amount offered. The lender may approve you for a certain amount, but your personal budget may tell you to spend less. Remember, the bank is reviewing whether you may qualify for a loan. You must decide whether the payments comfortably fit your life. Now, the fourth move, build a smart down payment strategy. It is important to understand the accounts and programs that may help eligible first-time home buyers. The First Home Savings Account allows eligible individuals to contribute up to $8,000 annually, subject to available participation room, with a lifetime contribution limit of $40,000. Contribution may be tax deductible and a qualifying withdrawal can be tax-free. However, your First Home Savings Account participation room generally begins after you open your first home savings account. Waiting several years to open one may delay your ability to accumulate room. The Home Buyer's Plan may allow an eligible first-time home buyer to withdraw up to $60,000 from the registered retirement savings plan to purchase or buy a qualifying home. You may be able to use the Home Buyer's Plan and the First Home Savings Account for the same qualifying purchase if you meet the conditions. However, they do not work exactly the same way. A qualifying FHSA, which is also the First Home Savings Account, withdrawal generally does not have to be repaid. An amount withdrawn through the registered retirement savings plan must generally be repaid according to the applicable schedule, or the required amount may be included in your taxable income. Before using either strategy, review your eligibility, your contribution room, timelines, and tax situation. And be careful about borrowing money simply to create an RRSP contribution. An RRSP loan creates an additional monthly obligation and is not automatically suitable for every home buyer. The fifth move, you should choose the right mortgage, not just the lowest rates. This move, you need to look beyond the advertised interest rates. A mortgage with a slightly lower rate may still have restrictive conditions or expensive penalties. Now let's compare. 1. Fixed and variable rates. 2. The mortgage term. 3. The amortization period. 4. Payment privileges. 5. Portability. And 6. Payment options. Lastly, the penalty for breaking the mortgage early. For uninsured mortgages, the current federal minimum qualifying rate is generally the greater of the contract rate plus 2 percentage points or 5.25%. This means you may have to qualify at a rate higher than the one you will actually pay. But passing the stress test does not eliminate risk. Ask yourself whether your budget could still handle higher payments at renewal, reduced household income, increased property taxes, or an expensive repair. Speak with a qualified mortgage professional and compare options. Do not automatically accept the first mortgage offered by your regular bank. Let us dive into the sixth move. Protect yourself during the purchase. The sixth move is to avoid allowing excitement or fear of missing out to remove necessary protection from your offer. Depending on the property and professional advice you receive, an offer may include conditions related to financing, a home inspection, reviewing condominium documents, the sale of another property, or legal review. A beautiful kitchen does not reveal the conditions of the foundation, plumbing, electrical systems, or roof. Investigate the neighborhood as carefully as the house. You should consider the commute, the schools, transportation, future development, insurance availability, property taxes, and resale potential. If you are buying a condominium, understand the monthly condo fees and have the appropriate documents and reserve funds information reviewed. Work with a qualified real estate professional, a mortgage professional, an inspection professional, and even a legal professional. Do not waive important protections simply because you feel pressured to compete. Finally, the seventh move, prepare for life after possession. This seventh move is to protect your finances after receiving the keys. Do not use every available dollar for the down payment, closing costs, furniture, and renovations. Keep an emergency reserve. Home ownership can bring unexpected costs soon after possession. You may discover that you need window coverings, appliances, tools, repairs, security, equipment, or seasonal maintenance. You should also ask what would happen to the home if your income stopped. Could your family continue making the mortgage payments if you became seriously ill, disabled, or passed away? Depending on your needs, a protection strategy may include emergency savings, workplace benefits, disability coverage, critical illness coverage, and personally owned life insurance. A mortgage default insurance is different. It primarily protects the lender when a borrower has a smaller down payment. Review your family's protection needs instead of assuming the mortgage itself protects your household. You may also need to update your will, beneficiaries, addresses, budgets, and overall financial plan after purchasing the home. The goal is not only to qualify for a mortgage, the goal is to keep the home without sacrificing your family's financial security. Now, in summary, here are the 7 smart moves again. 1. Determine whether you are financially ready. 2. Calculate the total cost of home ownership. 3. Prepare your credit and cash flow. 4. Build a strategic down payment plan. 5. Compare the complete mortgage, not only the rates. 6. Protect yourself during the purchase. And 7. Prepare financially for life after possession. Your first home should support your family's future, not become a monthly source of fear. Buy when you are financially prepared. Choose a home below your maximum pressure point and leave room in your budget for life to happen. Which stage of the home buying journey are you currently in? Are you buying your down payment, preparing for pre-approval, searching for a home, or getting ready to close? Comment home below. If you found this helpful, like this video, subscribe to this channel, and share it with someone planning to purchase their first home in Canada. If you would like a complimentary conversation about organizing your financial goals and protecting your family before purchasing a home, use the appointment link in the description. Until next time, purchase with clarity, not pressure.